biggest macroeconomic features of the coming week remain the Brexit talks between the UK and the EU, unrest in the Middle East, and US-China trade relations. Anything I say on these topics could well be out of date by the time you actually get to watch this, so I won't even try and comment. But it may be worth watching events in the EU for two other reasons. First, we have the latest updates of two key economic sentiment surveys, the German IFO and the Belgian Courbe Synthetique, on Tuesday the 22nd and Thursday the 24th respectively. As talk continues to swirl of a European, nay even a global slowdown, it'll be interesting to see how these surveys come out. In September, the IFO rose by 0.3 points to a reading of 94.6, and the Courbe improved by 0.1 points to minus 5.7. Maybe those are the first signs of stabilisation. We shall see. Secondly, European Central Bank President Mario Draghi will be hoping that there are indeed some positive signs here as he hosts his last policy meeting in the role on Thursday the 24th of October. That's the second big European event of the week. The Italian steps down on the 1st of November after 8 years in the job, and Christine Lagarde takes over amid gathering controversy over ECB policy. Remember, at the September meeting, Draghi announced a cut in the deposit rate to minus 0.5%, so most banks have to park their cash or pay to park their cash with the ECB, an unchanged refinancing rate of 0, and then a resumption of the quantitative easing bond buying plan at a rate of 20 billion euros a month. This chart shows the development of ECB rate policy and how its balance sheet has grown thanks to QE over the past decade or so. Now, Germany's Sabine Lautenschlager, she resigned in protest at the latest policy moves, and it seems that the ECB board was far from unanimous, despite Draghi's statement to the contrary. Questions are being asked about monetary policy and why should negative interest rates and QE stoke both economic growth and inflation now when they failed to do so in the West for most of the last 10 years and indeed in Japan for the last 25. Now, back on the domestic front, news flow is also going to pick up as we have a good number of trading updates, interim or final results due for release from large, mid and small cap companies. They include Reckitt Benckiser, Whitbread and McBride on Tuesday the 22nd, Metro Bank on the 23rd, and AstraZeneca, National Express and Stobart on the 24th. But the company which could well cause the biggest fuss in the week ahead for me, well, it might just be Barclays. The banking giant is due to publish its third quarter results on Friday the 25th of October. As we can see in this graphic, the shares have been neither use nor ornament over the past 12 months, sliding gently lower. The furore over the intervention of activist investor Edward Bramson over the role of Barclays Investment Bank appears to have passed, for now at least, and the company has already confessed that it will take a further provision for compensation payments for Payment Protection Insurance, or PPI. The cost of this extra compensation will be somewhere between 1.2 and 1.6 billion pounds on top of the 9.6 billion already taken. Now, it's fair to say that that figure is going to knock a fair hole in the third quarter result. In the third quarter of 2018, Barclays recorded a pre-tax profit of 1.5 billion pounds. This chart here shows the quarterly progress in stated pre-tax income back to early 2015. So one big swing factor will be the PPI charge, and including PPI, Barclays has suffered litigation and conduct-related costs of nearly £14 billion since 2013. Analysts will also be looking to see if there are any more restructuring charges and particularly loan impairment charges. Rising bad loans could be a sign that the global economy is indeed rolling over as borrowers struggle to fund their debts. And that may also, of course, be a reason why central banks have pivoted on monetary policy and started to cut interest rates rather than increase them. Impairments at Barclays did rise in the first half on a year-on-year basis, so this is a trend to be watched. The best news from the first half figures, though, was an increase in growth in deposits and loans. They helped to drive the top line after all, so keep an eye on that in the third quarter. The less good news, though, was that net interest margins on those loans remained under pressure, thanks to falling interest rates, competition and to some degree regulation. This will crimp future earnings power if the trend continues. The net interest margin in Q2, by the way, was 3.05%, down from 3.22% a year ago. Finally, watch the performance of the investment bank. A dud quarter or two could bring it back into focus, especially as Mr. Bramson and Courbe investors still own their stake and still argue that the capital-intensive operation should be downsized given its potentially volatile earnings stream. Thank you for watching, and I look forward to seeing you next time.